VYM is one of the biggest dividend-focused ETFs, and today we will explore if it is worth the attention it is getting from investors, and of course, if it is worth your attention. I will do a deep dive of the ETF and take a look at how it is constructed, what index it follows, and what it means for the future company selection criteria. Then, we will see how the fund has performed since its inception in terms of price, dividend, and total return performance, and also the current dividend yield and the level of concentration it has. After that, I will explore the sector allocation and what it means for the fund and your investments in it. Then, I will offer my thoughts on who the ETF is for, who it is not for, and finally, we will have a little bit of fun projecting how much money you could make if you decide to invest in it. So, by the end of the video, you will have a clear picture of the Vanguard High Dividend Yield ETF and whether this fund is for you or not. My name is Ognan, and I welcome you to the Dividend Method channel, where I talk about investing, personal finance, creating passive income, and I help people achieve or at least get close to financial freedom. The Vanguard High Dividend Yield ETF, ticker symbol VYM, was created in 2006, right before the financial crisis. This is important, and I will show you later why. For those that are new to investing, ETFs are basically a basket of stocks following certain strategy and methodology. VYM has a very low expense ratio of just 0.06%, typical for a Vanguard ETF. This means you will only be paying $6 per year for every $10,000 invested. It is one of the biggest dividend-focused ETFs with $57 billion in assets under management. The ETF follows a full replication approach, meaning that the fund actually owns the companies in it. This is the strategy I personally prefer because it means that every dollar I put in it goes into the holdings themselves, not into intermediaries that have swap agreements. If you don't know what that means, don't worry, it doesn't concern this ETF and is a topic for another video. The dividend yield of the ETF is currently 3.19%, which means for every $10,000 you put in it, you will get $319 as yearly dividends. Alright, enough with the general fluff. Let's get to the meat of the video. The most important part of any ETF review is to understand the underlying strategy and methodology that it uses to pick the stocks. If you don't do that, you are blindly throwing money at Vanguard and you will have no idea what you actually own and what you will own in the future when the market shifts and the companies in the fund change. So, what strategy does VYM ETF follow? The Vanguard High Dividend Yield ETF follows the FTSE High Dividend Yield Index, which measures the investment return of companies characterized by high dividend yields. Now, I have found that what is a high dividend yield is always subjective, and sometimes what is high for the index creators might not be high for you personally. So we will dig in the index itself to see exactly what the screening process is. As a start, the index follows only USA companies of all sizes, which is what OCAP means. It includes small, mid, and also the large names. So, we are basically starting with all companies in the USA as eligible. The index is reviewed annually, which is something I personally don't like. I prefer the indices in which I invest to be updated more regularly, since 12 months is a long time and a lot can happen in that time frame. However, this is fixed to some extent since there is a quarterly review for companies that have cut their dividends, which means that you won't have stocks that don't pay anything as part of your investment for too long. The next thing you need to know is that there are no REITs in the ETF because of the rule in the index that excludes them. As I have said in previous videos, I really don't like this as it removes otherwise great companies with higher than average yield that would otherwise bring the total yield of the fund higher without compromising the quality. The next rule overlaps with the previous one about the removal of companies with zero dividends, so I am not sure what purpose it has and why FTSE has included it a second time, but it basically says the same. And here comes my biggest red flag. As you can see, additional proprietary screens are also applied. I never like this when I see it in an index because it basically means that we don't have the full picture of what we are investing in. The index issuer is doing some magic tricks behind the scenes and we have no idea what will come out on the other side. After all, when we are investing our hard-earned money with any vehicle, I personally think that as investors we are entitled to the full picture of where our money is going and what is likely to happen in the future. In the case of the FTSE High Dividend Yield Index, I don't know if they are screening for fundamental strength, like for example, free cash flow or return on equity, if they are overweighting some sectors because of some specific view that the issuer has, etc., etc. So, in general, I am against that type of secrecy in the indices that the ETFs are based on. Now, from what I can see, there isn't a lot going on here. There aren't a lot of the fundamental metric rules I usually like to see in an index, like payout ratio, free cash flow, return on equity, and all that stuff. It is pretty basic and pretty broad. The stock has to pay a dividend, it has to be from the USA, and cannot be a REIT. And that's about it. To me personally, this is far from enough, and I always like to see additional filters for the companies. So this is the first place which for me shows that the ETF might not be something I personally want to invest in. However, there is a wild card, the proprietary screens. We simply don't know what filters FTSE applies here. So perhaps this is why the publicly available screens are not that many. In general, but especially in cases like this, I like to look at the top companies in the fund. When I see what kind of stocks make it to the top 10 or top 20, then I can kind of get an idea what the ETF is all about, even if I don't know all the screens applied. So let's do that now. Just a note, by the time you're watching the video, some companies might have changed, but the idea here is not to analyze them company by company, but to get the general idea of what types of companies the screens in the index choose. When I checked the top stocks, my initial negative sentiment towards the ETF born out of the lack of sufficient screens completely flipped because, boy oh boy, are these solid companies. Exxon, Chase, J&J, Procter & Gamble, Broadcom, Home Depot, Chevron, AbbVie, Merck, PepsiCo. I mean, it's really hard to beat that list. We have the two biggest energy companies, the biggest bank, two of the biggest consumer staple stocks, and three of the biggest healthcare companies. And not just big companies, but all solid ones with safe and growing dividends. Let's check the companies from number 11 to 20. Walmart, Cisco, Coca-Cola, McDonald's, Bank of America, Pfizer, Comcast, Wells Fargo, Intel, ConocoPhillips. Again, overall good companies. The list is not as great, in my opinion, as the previous one, and I would not want to own some of them, but it generally is an okay list. So, after seeing the top 20 companies that account for 39.63% of the ETF, there is obviously something going on with those proprietary screens. I'm not sure what it is, but I like the end result. These are mostly solid companies, especially the top 10, some of which I also have in my personal portfolio. Speaking of that, if you would like to see my top 4 stocks and ETFs I invest in for the current economic and geopolitical environment we are in, go to the link in the description and I will send them to your email for free. The report will always be up to date, regardless of when you are watching this, because I am constantly updating it. Okay, now that we went through the index construction, let's take a closer look at the ETF itself. We will now check VYM's age, performance, and concentration. Starting with the age, as I already said in the beginning of the video, the fund was created in 2006, and that is a great thing because we can see what a true prolonged recession, not like the COVID one that was covered by insane money printing, looks like, and how the ETF reacts to it. The fund's total return since inception has been 7.46% annually. The 10-year one stands at 8.6% and the 5-year at 7.22%. The dividend compounded annual growth rate, also called CAGR of VYM, has been 6.97% for the past decade, 5.6% for the past 5 years, 5.25% for the past 3 years, and finally 4.26% for the past 12 months. Now, there are several things about these metrics. The total return isn't the best, but bearing in mind the fact that the performance spans the great financial crisis, the 7.46% is not that bad. We can see that during the recession, the fund fell from about $55 per share to about $23 per share. This is a huge drop. In the span of just a year and a half, the fund basically lost half of its value. Now, this occurred during one of the worst crashes in the past 100 years, so it's understandable. And besides, as I said, if we go to the 10-year return, it grows to 8.6%, which is totally acceptable. However, what worries me here are the dividend growth metrics. When I look at an ETF, I don't like to see declining growth rates, and that's exactly the case here. The shorter and sooner the time period becomes, the worse the dividend CAGR becomes. Generally, I like to see the exact opposite. Now, granted, the past 2 years have not been the best for the economy and the stock market, and we have seen a lot of even blue, cheap, solid companies slow their growth, but here we see a decline for every period, not just the last 3 years. So, this is also something to note. We can see that the ETF had to cut its dividend by 24% from 2008 to 2010. It is obvious why they had to do it, but still, it shows that this fund is not immune to financial crashes, and both the share price performance and the dividends suffer. From that, we can come to the conclusion that VYM is not exactly a sleeper at night type of dividend ETF, which is a bit surprising having in mind that the top companies in the fund like Exxon, Johnson & Johnson, Procter & Gamble, Chevron, PepsiCo and others are dividend kings and dividend aristocrats, and not only kept but increased their dividend during the financial crisis. Of course, we have no idea what the top companies were back then, but this to me shows that probably the current composition of the fund's top companies does not exactly represent a superior quality screening process, but just luck that has placed very stable and profitable stocks among the top ones. However, most likely the proprietary filters are not enough to save the fund during crisis and help put stable companies that don't have to cut their dividend there. One of the other reasons for the weak performance during the crisis and the slowing dividend growth, despite the great overall performance of the top 10 companies, could be the fact that the ETF has 452 stocks in it currently. And unlike some other funds, like the S&P 500 for example, the Vanguard High Dividend Yield ETF isn't very top heavy. The biggest position currently accounts for just 3.61% of the fund. While this is good because VYM is highly diversified, the lack of quality screens in the index is likely allowing a lot of not so good companies to creep into the rest over 400 stocks that the fund is comprised of. In that case, we run into the problem of over-diversification. The term is used to describe a strategy where an investor allows too much mediocre and even low-quality companies in their portfolio simply for the sake of diversifying, which damages their performance and the average quality of the companies they own. Now, neither I nor you have time to go through 452 companies, but I suspect this might be the case for VYM. And here is another drawback of very widely diversified ETFs, which I also tell my students in the Dividend Method program to be aware of. The fact that after a certain point of diversification, you literally have no idea what is going on. You simply take what performance and results the fund gives you, and not only you can't do anything about it since it's not managed by you, but you can't even analyze it. When an ETF has 1,000 companies in it and its dividend goes down for the past 12 months with 6%, good luck finding out what exactly happened. This is one of the drawbacks of investing in ETFs, especially very broad ones, compared to single stocks where you can immediately analyze what is going on. This doesn't mean that such ETFs are necessarily bad, but it is just one of the negatives of investing in ETFs I point out in my program to the students so they can make their own rational choice regarding what mix of smaller ETFs, broad ETFs, and individual stocks suits their character and goals. Alright, we have looked at the index construction and also the performance of the ETF. Let's now look at the sector breakdown of VYM so that you can get a better understanding of where your money will be going if you decide to invest in it. Also, this might give us a bit more of an insight into the way the fund works since, as I already pointed out, not everything is clear with this ETF. The first sector is financials at almost 20%. The financial sector includes companies related to banking, insurance, investment, and financial services. These companies provide services such as loans, savings accounts, insurance policies, investment opportunities, asset management, etc., etc. The financial sector is generally considered cyclical because its performance is closely tied to the broader economy and it tends to do well during periods of economic growth, but may face challenges during economic contractions. This is because during economic expansions, banks tend to see higher lending activity and profitability, while investment firms benefit from increased investment activity. However, this sector can be vulnerable during economic downturns, especially if there is a financial crisis because of reduced economic activity, loan defaults, and falling asset values, all of which can impact financial companies negatively. Big companies in the sector include JP Morgan Chase, Visa, Morgan Stanley, BlackRock, etc. The financial sector is a sector I'm personally neutral on as I don't personally have a big exposure to it. However, it being about 1/5 of the ETF is not something I like. There are two things that have always worried me about the financials. First, When it comes to banks, they are entirely dependent on trust, and literally one bad piece of news or one tweet by a famous person can bring the whole thing down if people decide to withdraw their deposits. It's not like a Microsoft or a Procter & Gamble, which sell products or services people use and need every day. And the second is technological change. Blockchain technology or central bank issued digital currency can flip the whole business model of an asset management firm or a payment processing company upside down. So, to sum up, even though there are great companies in the sector, I just don't feel comfortable with that big of an exposure. Second sector is consumer defensive, also known as consumer staples, at 14.5%. The consumer staples sector includes companies that produce everyday essential products that people use regularly, like food, beverages, cleaning supplies, tobacco, and basic household items. Consumer staples are considered defensive because people need these products no matter what the economy is. I hope you still brush your teeth and wash your dishes even if there is a recession, right? Big companies in the sector include Procter & Gamble, PepsiCo, Coca-Cola, Unilever, and others. I personally like this sector a lot, and I like to see it as a bigger part of the ETFs I invest in. It is very resilient and gives you a steady growing stream of cash without a lot of volatility. So I like the fact that it is the second biggest sector of VYM. Next is healthcare at 13%. The healthcare sector includes companies that make medicines, medical devices, and provide healthcare services. For obvious reasons, healthcare is primarily considered defensive, which means the profit of the companies is not affected as much by recessions. Its products and services are essential, and the demand tends to stay the same regardless of economic conditions. Obviously, if you are sick, you still take a pill and you don't care if that means that you're not eating out tonight, right? Big companies in the sector include United Health Group, Johnson & Johnson, Pfizer, and others. I generally like seeing this sector as a bigger part of an ETF because, as I said, the companies there have fairly consistent earnings regardless of the economic conditions. One thing I don't like about healthcare is that the pharmaceutical industry relies a lot on patents. That means that a company can be on the top of the world this year but have its profit reduced by 50% next year because they are no longer the only producer of a certain drug. That risk, however, is reduced when you own a bunch of them in an ETF because you are not reliant on a single company's medical breakthroughs. The fourth sector at almost 12% is industrials. The industrial sector is comprised of companies involved in the manufacturing and distribution of goods and services related to industrial production. It includes companies that make and provide things like machinery, airplanes, and construction and transportation services. Their performance tends to correlate with economic cycles, so during economic expansions, the increased business activities, construction and infrastructure development, etc., drive growth in this sector. However, industrials can be vulnerable during economic downturns when demand for industrial products and services decreases. So, basically, it is one of the sectors considered cyclical. Its performance is closely tied to the overall health of the economy, and it tends to do well during periods of economic growth, but may struggle during recessions or economic contractions. Big companies in the sector include Caterpillar, UPS, Boeing, and others. The sector is a bit of a double-edged sword. It is great because during good times it will probably contribute to good results for the ETF, and it means that the fund will benefit from the onshoring trend in the USA and the decoupling of the supply chains from China. However, it also means that the earnings of the companies in the top sector might suffer a lot during a recession, which will mean weaker growth for the ETF. I mean, just take a look at the earnings of one of the top industrial companies, Caterpillar. Fifth sector, at 11%, energy. The energy sector involves companies that produce and distribute energy resources like oil, natural gas, and electricity. It includes industries such as oil and gas exploration and production, renewable energy, energy transportation like pipelines, etc. The oil and gas industry's performance is closely tied to the price of oil and gas and also to the demand for these resources, and so it's highly cyclical. When the economy is slowing down, factories produce less products, people travel less, and so oil and gas companies make less money. So in general, the sector is considered cyclical. An exception to that are the pipeline companies, which offer a lot more predictable cash flow due to their long-term contracts that are often not connected to the price of oil and gas. However, sometimes their cash flow is dependent on the volume of the products going through the pipelines, meaning that if the demand slows down, they will suffer too. Major companies in the sector include Exxon, Chevron, Shell, and others. Unlike what the environmentalist crowd wants you to believe, these companies are not inherently bad and their business isn't going away anytime soon in the next decade. So I feel pretty okay with them being such part of the ETF. Sixth place, with almost 10%, the technology sector. The technology sector includes, you guessed it, companies involved in developing, manufacturing, and selling technology-related products and services. Businesses in the sector create products like smartphones, computers, software applications, internet services, semiconductors, etc. The technology sector is usually considered cyclical as it can experience ups and downs with economic cycles, but it often provides opportunities for long-term growth due to the technological innovation. On top of that, some of the companies in the sector are so big and have basically a monopoly or duopoly on a certain market that even during recessions, their profits are relatively safe. Big companies in the sector are Apple, Microsoft, Nvidia, and others. This sector is the biggest component of ETFs like the S&P 500 or the Nasdaq 100, and you can see that it is currently only around 10% of VYM. Having in mind the recent developments in AI and the growth of a few big tech-related stocks, it is no wonder that the Vanguard High Dividend Yield Fund has underperformed these ETFs. However, that doesn't necessarily make it a worse investment. It is just a different ETF created for a different purpose. The technology sector is not known for its big dividend yields or dividend-oriented policy because these companies need to reinvest a lot of their capital into developing new technology to stay competitive. Hence, you won't see it as a top sector in a lot of dividend-oriented ETFs, regardless of the fact that it is the biggest sector in the economy. Whether that is good or bad, you decide. I personally am a bit torn about it, as I know that this is the quote-unquote sector of the future with the biggest potential growth. However, at the same time, I am a cash flow investor, and so locking my capital in sectors and companies that don't pay me a dime for 15 years seems stupid to me. But everyone is different, and it is up to you to decide for yourself whether you want bigger exposure to it or not. If you do, this ETF is probably not for you, as by design the screens won't allow a lot of tech companies. The seventh biggest sector is the utilities sector at almost 7%. Well, what can I say about utilities? We all pay them, none of us can go without them. The utilities sector includes companies that provide essential services related to electricity, gas, and water. The sector is considered defensive and stable because it provides essential services that people and businesses need regardless of economic conditions. Demand for utility services remains relatively constant, making the sector less sensitive to economic ups and downs compared to other sectors. As an income investor, this is why I like to see a bit bigger allocation in it. However, have in mind that this is one of the slowest growing and most regulated sectors of the economy, so don't expect wonders from it. It's a slow and steady cash cow that will generally keep you afloat during bad times and lag sectors like tech or industrials during good. The eighth place is for the consumer cyclical sector, also known as consumer discretionary, at 6.6%. The name pretty much explains it. The consumer cyclical sector includes companies that provide products and services considered non-essential or wants rather than needs. Think luxury items, travel, entertainment, etc. Consumer cyclical companies are, surprise, highly cyclical, meaning their performance is closely tied to economic conditions. During economic expansions, people tend to spend more on discretionary items, benefiting this sector. However, during economic downturns, consumers cut back on discretionary spending, impacting the sales and profitability of the companies. Big companies here include Amazon, even though I personally think it is a technology company, but whatever, Tesla, Nike, etc. For me, being a more conservative dividend investor, I don't like to have this sector as a big percentage of my ETFs. However, it provides a good opportunity to take advantage of a booming economy coupled with high consumer confidence. So this percentage of VYM being in cyclicals is fine with me. Okay guys, just a few left. Next is communication sector with 3.72% of the VYM ETF. The communication services sector includes industries such as telecommunications, media, including social media, broadcasting, and others. The communication is not classified as a typical defensive sector, however, it is less cyclical than most of the others because it provides essential services. Regardless of whether there is a recession or not, very few people nowadays can stay even a day without phone and internet. So the demand for their services is pretty stable. However, the companies need to adapt to constant changes in technological environment. For example, a business like AT&T might have been the biggest business in the sector 1 decade, but then social media comes along and suddenly Meta is a far bigger company because of a profound technological change. Last sector with 2.45% of the fund, basic materials. The basic materials sector is comprised of companies that produce, obviously, materials. It includes industries such as mining, chemicals, forestry, and metals. The sector is highly cyclical, meaning that its performance is closely linked to economic cycles. During economic expansions, there is increased demand for raw materials in construction, manufacturing, and infrastructure development. Then, during recessions, companies can face challenges when demand for these commodities decreases because of less economic activity. Also, businesses in the sector are highly sensitive to the price of commodities, which adds additional volatility to them. You can often see companies with very high dividend yields in this sector, but you have to be ready for them to get cut by 40% next year and then go up by 60% in 3 years. Big companies include Rio Tinto, BHP Group, Glencore, and others. The sector is not for investors who rely on dividends to pay their bills. Because of that, I am generally cautious with it. However, it plays a vital role in our society that is not going away, and arguably, with the push for green energy, the basic materials companies will only get more important because of the exponential need for lithium, copper, nickel, steel, etc. Because of that, I would personally like to see this sector a bit higher in an ETF than it is in VYM. And the last sector, I'm really not sure what is going on here. Real estate was supposed to be excluded from the ETF, however, here it is at 0.01%. I suspect this is the value of some brick that has been forgotten in the Vanguard's office room where the managers of the ETF work, and so it is counted as an asset. Who knows? Okay, so now that we have all the information about the ETF we need, you're probably wondering whether I recommend you to own it or not, and what is my opinion of it. First, as most of you know, I will never give any financial advice about buying or selling particular security, so I can't tell you what to do. However, I can give my opinion of the fund, and here it is. VYM, honestly, is an ETF that leaves me with mixed feelings. That sounded like a quote from a romantic drama movie. On one hand, you have very weak filters being applied by the index it follows. There aren't quality screens like payout ratio and free cash flow or profit margins, allowing only companies with fundamental strength in it, which results in basically almost non-discriminatory approach for letting stocks in. This can be seen in the number of companies in the fund, which stands at around 450 currently. Now, on the other hand, that ensures very broad diversification, but there could come a point, especially without quality filters, where we get into over-diversification, as I discussed previously. And that means letting companies in that I would not like to be there. Talking about the companies, when I took a look at the top 10, I was really impressed as all of them were strong businesses, some of which I personally hold as individual stocks. However, because of the lack of transparency in the proprietary filters applied by the index issuer FTSE, I have no idea what the situation could be in a year or two, and that makes me nervous. On top of all that, the ETF's dividend growth has been falling for every period I have looked at, and the yield being a little above 3% is not high enough to compensate for that, even though the fund's name actually involves the words high dividend yield. To sum up, in my opinion, the Vanguard High Dividend Yield ETF is an okay fund for people who just want a very broad diversification across hundreds of dividend-paying companies from the USA, regardless of their quality, and don't mind average results. Perhaps you feel a lot safer that way, prefer less concentration, and want to own basically the majority of the dividend stocks in the States. That's fine, but you have to know what the trade-offs are. And they are suboptimal results compared to more quality-oriented ETFs, and complete lack of transparency and idea where your investment dollars are actually going. Alright, now to the fun part. Let's get on to the dream bus and see how VYM can compound your wealth and cash flow using my favorite dividend reinvestment calculator. Of course, depending on the amount you have and how the future market develops, it might turn out to be a pretty realistic picture of the trajectory of your investments. This is why I always like to use this calculator, because it helps you see the long-term power of investing into quality cash flowing assets. But before that, if you're getting value out of this video, click the like button and also subscribe to the channel by clicking the subscribe button and then the notification bell. That way you will be directly notified when I release new videos instead of relying on the algorithm to show them to you. The amount of engagement I get shows me what types of videos the audience enjoys, so I know to make more of them, and so this feedback is really valuable to me and to the channel as a whole. Okay, back to the dividend snowball calculator. We will start with $10,000 that you invest once and you never touch it. Then we input the annual compounded percentage increase in the stock price. I get this by measuring the first price of a share available, which is 50.38, and I input the current price, which is $105.27. When I put that in a CAGR calculator for 17 years, the result is 4.43% in annual compounded growth rate of the share price. So this is what we put in our calculator. For now, we will put 20 years, but we will play with that later. The current dividend yield is 3.19%, so we put it in the calculator as well. I will get the expected dividend growth rate using the information of the first and last annual dividend, starting in 2007, since this was the first full year. And I will use the same calculator to check the compounded growth rate, which is 6.03%. We put that in the calculator as well. We turn on the dividend reinvestment plan, meaning that your dividends will be buying more shares, which buys you more dividends, thus creating the famous dividend snowball effect. And finally, since the tax rate is different for everyone, but it most likely is not realistic to leave it at 0, even though for some people in some countries this is possible, let's put it at 10%. If we do that, our $10,000 in 20 years will have quadrupled to $4,500, and we will be getting $1,666 in yearly dividends. Let's check the results on the 30th year. Our $10,000 went up 9 times to $90,000, and the dividends per year went up to $4,300, giving us yield on cost, which means the yearly dividend on our original investment of 43%. Now, let's see what happens if we invest $1,000 every month for 20 years consistently without any other starting capital and by reinvesting the dividends. In 20 years, we have $476,000 portfolio with $19,000 in yearly dividends. And if we do it for 30 years, we will have $1,236,000 portfolio with $58,000 in yearly dividends. Then finally, let's see what happens when we save or earn a little bit more and invest $2,000 monthly. At the end of the 20-year period, you will have $951,000 portfolio and $38,000 yearly in dividends. And on the 30th year, your portfolio size will grow to $2,472,000 with a huge $116,000 yearly dividend. This goes to show you what just a few extra years in the market can do to your returns and cash flow. Of course, we are all grown-ups here. If you are not, stop watching and go do your homework. And we all know that the future projections are never certain, so I don't need to tell you that the numbers will definitely be different. How different? Only God knows. So, with that in mind, are these results good or not? It's up to you to decide. I already gave my opinion on the ETF, so I won't repeat myself here. I also can't tell you how much money you can save and invest or how much cash flow you need to live the life of your dreams. What I can help you with, though, is to get more educated and either start your dividend investment journey, or if you already invest, to improve your knowledge. This is why I want to invite you to my free dividend investing masterclass, for which you can find the link in the description. It is a value-packed event where you will get a ton of in-depth education for free in the span of just a few hours. So go to the description where the sign-up link is, and I hope to see you there. So let me know in the comment section, what are your thoughts on VYM? Do you invest in the ETF? Are you planning to do it? And what do you think about all the things discussed in the video? I personally read and reply to every comment I get, So I really appreciate when you guys let me know your opinion, either on the video itself or on the matter discussed in it. And before you go, click on the video that will appear on your screen right now to continue with your investing education. Thank you for watching, and I will see you there.